Hello. This is Mike Taylor, aka BattleshipCobra, and this is the second video in the Financial Accounting Foundation series. Today we're going to cover basic topics such as debits and credits. Before I get started, if you have not checked out video 1 in the Accounting Foundation series, go back and check it out. Each video builds on the next one, so if you haven't seen it, check it out now before watching this one. It'll make more sense. Check out www.battleshipcobra.com for more information, including my SQL for SAP Business One and my Crystal Reports for SAP Business One course. If you like this video, like it. If you want to see more, subscribe. And if you want to be notified by email, join the notification squad by clicking the bell below, and you'll get an email every time I make a video. I make new videos weekly, Mondays, 9 a.m. Pacific Standard Time. I'm wearing this costume because it is October 2020 and I'm being festive. The reason I'm doing these videos is because I realized I was getting a lot of questions from consultants that weren't necessarily comfortable with the accounting side of the SAP system, and I want to provide some basic concepts for you to get more familiar with it and to understand more of the concepts behind the GL account determination accounts and some basic accounting concepts to make you a better consultant. So today we're going to cover more basic stuff. Let's get started. So to remind everybody from the last video, we have the double entry system, which creates the basis of all transactions in SAP and in a general accounting system. SAP follows generally, GAAP principles. So you have a double entry system that's comprised of journal entries. The journal entries affect one or more accounts. Those one more accounts have to have a debit and a credit, and those have to be equal. It's designed to be a cross check so that when you do a transaction, you can't just increase inventory and then you're like, well, where did this inventory come from? There's always something happening to cross check those transactions to keep better track of where the money's coming in and going out, and to reduce fraud and to reduce issues. Totals and balances just appear and disappear. So it keeps track. It's like the bean counters, the audit trail. You're auditing the whole process. So the general ledger you can look back in the transaction where all the dollars are coming from. So here's an example of a basic incoming payment. Your accounts receivable is decreasing by 1,000 and your bank account is increasing by 1,000. I'll explain how you know what's increasing and what's decreasing, because a debit and credit are not always equally decreasing and increasing. It gets confusing. Here we go. So there are account types. Like I talked about, you have assets, liabilities, equity, revenue, COGS, and expenses. So these are just the rough ones. There's other drawers, but these roughly equate to the drawers of your SAP Business One chart of accounts, financials chart of accounts. Assets are, again, roughly something that the business owns. So it can be machines, it can be cash, it can be stuff that the business owns. Liabilities is what you owe as debt to other people, and it is like accounts payable, loans, etc. And equity is basically what you owe through owing to owners. So it's your retained earnings, it's your equity, it's who owns it, and your shares broken down and everything. So you have assets, liabilities, and equity. Assets, liabilities, and equity equal the balance sheet accounts, and those are the body of the ledger. Too weird? Yeah, probably. Revenue, COGS, and expenses. Revenue is the money you brought in. Obviously, the money you brought in isn't the whole story. You get $1 million revenue, you're like, wow, I'm a millionaire, man. And it's like, no, there's more to it, okay? COGS are the direct expenses that led to that revenue. So if you sold a widget, it's the direct cost of that widget that you sold. So that's cost of goods sold, okay? So those are always direct inputs directly into the margin of the activity that you're doing or the product that you're selling. Expenses are below the margin and expenses are what it costs to basically run the business in order to do those activities. So revenue minus COGS is your gross margin, and then expenses, that's your net margin. I think so. And after the revenue minus COGS minus expenses, that what's left is your profit. So you have your revenue, it's what you made. COGS is what it costs to make that revenue, and then the expenses are the activities of the business, other like wages, other things that are not directly related to the product or service. So that's like rent, internet, salaries, insurance, overhead stuff, other things like that. So assets, liabilities, equity, balance sheet, that's your body. And those just stay there. Revenue, COGS, and expenses, that's your activities, and we'll talk more about that later. So the mental framework and methodology, what we have to start to think of, and this is literally getting into the hardest part of accounting. Once you get this, you will get everything in accounting, basically. This is the hardest part by far to grasp, and I'm going to do my best in order to explain it. What I do is when I'm saying, what should this affect? I think, what 2 or more accounts am I affecting? What am I doing? Is the customer owing me more money? Am I making revenue? Is there a cost? Am I sending inventory out? Is this an expense of mine that I'm gonna have to pay money on? Start to think, what am I doing? And we'll talk more transactional next video. So each of the types of accounts has a natural balance to it, where when you're increasing it, it's one way, and when you're decreasing it, it's another way. So as a general overview, and I'm going to go into this next slide more, a naturally debit balance account is an asset, a cash account, a cost of goods sold, or an expense account. A naturally credit balance account is a liability, a debit, a debt, like a credit card, a revenue, or an equity account. So once you memorize these basically, and I'll show you more, you can then say, am I increasing or decreasing? And what type of account is it going to be roughly? And then you can kind of logic your way through what the journal entry should be, okay? Let's drill into this a bit more. Account types revisited. So we're seeing the same types of accounts with some expanded data here. So with this, I've added a little bit more information. So this is basically Accounting 100 broken down into one slide, effectively. There's no great way to learn this other than to really memorize it and to work with it and just write it down and look at it. But once you get this, you basically are an accountant. So if you look at it, you have your assets, liabilities, equity, revenue, COGS, and expenses. And if you look at the 1, 2, 3, 4, 5, 6, assets typically start with a 1, liabilities start with a 2, equity starts with a 3, revenue starts with a 4, COGS starts with a 5, and expenses start with a 6. An asset account has naturally a debit side, as debit side is being positive. So DR stands for debit. I have no clue why. Credit is CR. So an asset, to increase an asset, you debit it to make it go up. And you credit it to make it go down. So what exactly is an asset? Again, an asset is something that you own. So you have a bank account. So you want a bank account, inventory, equipment, vehicles, computer equipment, stuff that you own. The assets are if you debit them, they go up. So you're debiting a cash account, it's going up. Number 2, liabilities. Liabilities is, remember, it's what you owe to other people. A credit, they're naturally credit balance. So a credit is adding to them, making them more, and a debit is decreasing them. An equity is level 3. Credit increases them, debits decrease them. Number 4, revenue. It's a 4,000 level account, or it could be 400, whatever. It just starts with a 4. A credit increases them, and a debit decreases them. 5, cost of goods sold. A debit increases it, and a credit decreases it. And 6, an expense, same thing. A debit increases it, and a credit decreases it. So it offsets all of the revenue. Just memorize it. I don't know what else to say. we'll talk about it and it'll become more logical to you. But just look at this chart, write it down, take some notes, and it'll make more sense. This is really probably part of the key of what screws people up the most, takes the most amount of time to learn, and has no true logic for it, but trust me, it does work out. So let's take a quick look at the chart of accounts, and I will show you what these accounts are and just briefly about the numbering system. So here we are, modules, financials, chart of accounts. 1 in the assets, 1. These are all 1,000 level. 2 liabilities, these are all 2,000. Equity, these are all 3,000. Revenues, 4,000. COGS, 5,000. Expenses, 6,000. So that's how you can see it, and this is very standard. You could do more in these ones, 7 and 8,000, it's up to you, but those general classifications don't change. Those drawers don't change business to business. They're always the same. So more on the chart of account structure. Again, I wanted to talk about the balance sheet is like the body of the business. These are perpetual things where you run them on a specific date and it tells you what your body of your business looks like. What do you own? What do you owe to other people? And what do you owe to your owners, or what is owned? What percentage of the business is equity, shares, etc. Profit and loss is the activities of the business, revenue, COGS, and expenses. Revenue is what you've earned. COGS is what it costs you directly for that revenue. And then expenses are overhead and other things that aren't directly related to your products and your services. This ties into your financial accounts because you have a balance sheet. Again, it's your body. Your body doesn't just disappear. You run it on a single day and it includes the full history of the business. So it's like cash is going up, it's going down, and it's like, here's a picture at the end of the year, and here is where we are in terms of the body of the business. What do we own? What do we owe? What's our profit? What do we owe to owners? P&L, what's called a P&L, profit and loss, is run for a period of time, usually a financial year. And that financial year P&L will tell you between those two dates what your activities were. So you're going to have a total revenue for the year, a total COGS, and a total set of expenses. Those give you an idea of the activities that you've done, and they are reset annually. So you actually net all those balances up and roll them up to equity, and that is your net gain or net loss for the year. So when you start a new financial period, you'll actually start at zero. So when you start, like, say you're January 1st, it's a fresh year. Now it's like, boom, off to the races. You're closing all of your previous year. December 31st, typically. Financial years don't have to be the same as calendar years, but in a lot of cases they are. And so you will close December 31st, and then you open at zero in your P&L accounts. Your balance sheet accounts aren't reset. They're run as of December 31st. You have a trial balance, which basically is just a balance of your debits and credits for all those accounts and a picture of where they are at a particular time. A lot of accountants will try to balance the trial balance with the balance sheet and the profit and loss just to cross-check. Again, they're going to do it with the accounts receivable aging and accounts payable aging with those subledgers we talked about, and they're going to use the inventory audit report as well to blow apart the inventory to show the details to an auditor and maybe like internal stakeholders. General ledger is just a list of transactions. The general ledger could be considered all debits and credits for the whole business, usually broken down by accounts, and it'll just be debits and credits, debits and credits, debits and credits for the whole year. So debits and credits are all broken down into account segments, account titles, and giving meaningful structure by the chart of accounts. Debits always equals credits. So if you run a balance sheet P&L, it's always going to total up for a period of time. It's always going to equal. If it doesn't equal, you have a very serious corruption in your data, and that's something you need to worry about. I want to reiterate this chart here. You need to memorize it. Assets are number 1, liabilities number 2, equities number 3, revenues number 4, COGS number 5, expenses number 6. Assets are naturally debit balance, liabilities are naturally credit balance, equity is naturally credit balance, revenues are credit balance, COGS are debit balance, and expenses are debit balance. So if you want to think about am I increasing or decreasing, think about this chart and have this next to you. So what we want to do is stop and think. What are we affecting? What accounts are we affecting? And will we be debiting and crediting them? And then we can kind of get a sense of what the journal entry will look like. So here's a good example of an invoice. Okay, so we're doing an invoice that doesn't have a delivery. So it's going to do both the delivery and the revenue entry at the same time. So we're going to charge $1,000 to the customer that they're going to owe us. So accounts receivable, and there'll be a subledger, say BattleshipCobra. Because of that $1,000, we made $1,000 revenue. So those two are a pair. And then you issued out some inventory and your cost was $500. So your $500, that's a 1,000 level account. You're decreasing your inventory by $500. COGS is going to increase by a debit and you're increasing your COGS by $500. So you're turning an asset. Now it's off of you don't own that inventory anymore. You're decreasing that asset and you're increasing your cost that you sold against your revenue for that transaction. So you can see you made 1,000, cost you 500. You don't have the cash for that yet, so it's in accounts receivable until the customer actually pays. At the time the customer pays, you do another entry to record a payment, and that will decrease the 1,000 level asset with a credit, and then it'll increase your cash, your bank account by 1,000, and that will be a debit to the bank account. So take a look at that. Again, that's just an independent invoice with no delivery there. I just did them together just to give you kind of this compound look. 1,500 debit, 1,500 credit. Boom, everything matches up, and that is very simplified, but there's no tax, there's no freight and other things. This can be much more complicated in here. There could be multiple classes of revenue, other stuff like that, but for now, this is as simple as it's gonna get. So I need you to look at that chart, think about what you're going to be affecting. Is it a 1,000, 2,000, 3,000, 4,000, 5,000, 6,000 level account? Are you gonna increase or decrease? Are you increasing what you own? Are you increasing what you owe to other people with 2,000? Are you affecting equity? Equity accounts aren't affected that frequently. Is it sales that you just did? Did you just sell something? Cost of goods sold? Did you sell some inventory? Or do you have direct costs like direct labor? Or was it an expense? Is it like rent? Is it like internet? Is it like one of those things that you have? You will think logically about the transaction, and in the next video, I'll give you more transactions to think about. Thank you guys so much for checking out this Accounting Foundation video. I really appreciate it. Visit www.battleshipcobra.com. If you like this video, like it. If you want to see more, subscribe. If you want to join the notification squad, click the bell. You'll get a notification email every time I make a new video, which is great if you don't come back to YouTube all the time. I make new videos weekly, Mondays at 9 a.m. Pacific Standard Time. Again, thank you very much. I will have a part 3 of this video series